All right, let's jump right into this explainer. Today, we are demystifying the sometimes chaotic world of business financing. We're going to examine the practical realities on the ground, the incredibly strict accounting standards you have to follow, and of course, the rigorous tax rules that govern your money. Whether you're a small business owner just trying to keep the lights on or a financial pro structuring some massive corporate deal, understanding how these three areas collide is absolutely critical. So let's get right to it. Here is our roadmap for today. We'll start with the cash flow crunch, decode the sale-leaseback, compare IFRS and ASPE accounting, lay out the rules of borrowing, trace your interest deductions, and then wrap it all up with the bottom line. Starting with part one, the cash flow crunch. So is it smart cash flow or just an expensive loan? Somebody actually posed this exact question recently on a Canadian small business forum, and it was coming from an equipment financing broker. It hits on a very real, very urgent need for a lot of folks. How do you pull capital out of your existing assets without literally halting your daily operations? I mean, when cash feels tight, business owners naturally start looking at that heavy equipment sitting on their shop floor, wondering how they can unlock the equity that's just trapped inside of it. You know how it is. Business owners constantly need to tap into that equipment equity to fund immediate pressing expenses. We're talking about plugging gaps in payroll, making bulk inventory buys, covering those soaring fuel bills, or even funding a sudden growth project. But there's a catch here. Older or highly specialized equipment, it inevitably faces much lower valuations and way stricter financing conditions. It's just not as easy as it sounds. Moving on to part two, decoding the sale-leaseback. So to solve this, a lot of people turn to a specific mechanism called a sale-leaseback. It's pretty much exactly what it sounds like. It's a transaction where a finance company buys your equipment at an agreed value, hands you the cash proceeds, and then immediately leases that exact same equipment right back to you for a fixed term. It's brilliant in a way because you keep using your equipment like normal, no disruptions to your workflow at all, and you get that lump sum of cash. But obviously, it means you now have a fixed monthly payment hanging over your head going forward. And we really need to highlight a harsh reality here. This is not free money. The broker in that form emphasized that sale-leasebacks often end up costing significantly more than your traditional bank loans. Plus, think about this. If you already have a lender on title for that piece of equipment, you have to pay them out to clear the lien before you see a single dime of those new sale proceeds. It's definitely a strategic financial tool, for sure, but it comes with very real, tangible costs. All right, part three. The accounting aspects versus IFRS. Depending on which framework your business uses, there is a massive structural shift in how you report this stuff. Under ASPE, that's for private enterprises, leases can often be classified as operating, which means they magically stay off balance sheet and just show up as a regular expense. But under IFRS 16, it's a whole different ballgame. Practically all leases have to be recognized on balance sheet as a right-of-use asset along with a corresponding financial liability. That makes a huge difference in how your company's financial health actually looks on paper to an outsider. Now, if you are a private enterprise using ASP, you have to be super careful. Meeting just one, literally just one of these bright line quantitative thresholds turns your quiet, off-balance sheet operating lease into a heavily regulated capital lease. If the lease transfers ownership, if the term is greater than 75% of the asset's economic life, or if the present value of the payments hits 90% or more of the fair value, boom, it goes straight onto your balance sheet. And when we're talking about a sale-leaseback specifically, IFRS 16 takes a totally different path than ASPE. ASPE basically just looks at whether the resulting lease is capital or operating to figure out how to defer any profit. But IFRS 16 is way stricter. It demands that the initial transfer of the equipment must actually qualify as a true sale under a completely different standard, IFRS 15. If the auditors say it doesn't qualify as a true sale, well, you can't take the asset off your books, and that big pile of cash you just received is simply treated as a financial liability. Which brings us to part four, the rules of borrowing. Let's say you decide to skip the headache of a leaseback altogether and just take out a traditional loan to get your cash. Well, we need to talk about the CRA's incredibly strict tax rules for deducting interest. According to the CRA, and backed firmly by the Supreme Court, for a payment to legally be considered interest for a tax deduction, it has to meet three exact criteria. It must accrue day to day, it must be calculated on a principal sum, and it has to represent compensation for the use of that principal. If your payment fluctuates based on profit or cash flow, it's generally not going to qualify. And here's a real light bulb moment for a lot of people.
An unpaid purchase price is not borrowed money. It's merely a seller-purchaser debt. It completely lacks the lender-borrower relationship required to be considered a loan. Case law draws a very hard line here. Actually, if you buy equipment and owe the seller money, you are deducting interest under a totally different part of the tax code rather than the standard borrowed money provision. The legal wording really matters to the CRA.
This brings us to a famous Supreme Court decision called LUDCO, which defines the vital purpose test. Basically, to deduct your interest, the borrowed money must be explicitly used to earn non-exempt business or property income. The court clarified that income here means gross income generally, not necessarily net profit. But you absolutely must have a reasonable expectation of generating that income at the time you make the investment. No window dressing, no shams, it has to be legitimate. And that leads right into Part 5, tracing your interest deductions. So, having established that you have to borrow for an income-earning purpose, how do you actually prove that to an auditor? The Supreme Court mandates that the onus, the burden of proof, is entirely on you, the taxpayer. You have to trace the physical borrowed funds directly to a specific current income-earning use. It doesn't matter what you originally used the money for, it's all about what those funds are doing today. If that direct link gets broken, or if the funds slide over into a personal use, say goodbye to your interest deduction.
The problem is, money is fungible. A dollar is a dollar. So mixing borrowed funds with your normal operational revenue makes tracking an absolute nightmare. The fix? It's a strategy called cash damming. You basically use physical buckets, like setting up two completely separate bank accounts, to prevent any commingling. You deposit the loan into one account, and you only pay eligible deductible business expenses out of that specific account. It makes proving that direct link to the CRA incredibly easy.
But hey, what if you mess up? If you do accidentally mix your funds or say you sell a property at a painful loss, don't panic just yet. The CRA actually offers some specific lifelines. A flexible tracing approach lets you allocate commingled funds to eligible uses on a dollar-for-dollar basis. And if you borrowed money for a business asset, sold it at a loss, but you still have a huge loan balance left over, well, the disappearing source rules can sometimes step in to help save that deduction.
Finally, Part 6, the bottom line.
Let's piece this whole puzzle together. We've covered a lot of ground today, all the way from the shop floor right up to the Supreme Court. Ultimately, whether you're using a sale-leaseback to free up some quick equipment equity, or you're just taking out a traditional bank loan, optimizing your cash flow means strictly matching your financial tools to these distinct realities. You absolutely need to know how a transaction will look on your balance sheet under your specific accounting rules, and you have to operate with military precision when tracing your borrowed funds to protect those vital tax deductions.
I want to leave you with this final thought. The next time your business faces a sudden cash crunch, or maybe you're eyeing a massive expansion, what exact steps are you going to take to ensure your short-term financing solution doesn't mutate into a long-term accounting and tax nightmare? Plan your structure, know your framework, and for goodness sake, trace your funds. Thanks for joining me on this explainer, and keep learning.